Good morning, everyone. We're going to get started. People are just starting to come into the webinar and we'll be getting ready. We'll be getting started in a moment. They trickle in slowly. Good morning, Celine. So good morning, everybody. I'm Kimberly Foreman from the Newport Beach Association of Realtors, and we have Bobby Jordan with the Laguna Board of Realtors. Hi, Bobby.
Good morning, everyone.
And I'm excited that we've been able to bring you a really great economic update and a potential forecast and basically where we've been, where we're at, and where we're going. So we have Jordan Levine here. He's the Vice President and Chief Economist of the California Association of Realtors. Jordan's responsible for C.A.R.'s housing market and economic research, as well as policy analysis for C.A.R.'s legislative and government affairs efforts. Jordan has a bachelor's degree in economics from the University of California, Santa Barbara, and a master's degree with merit in international economics from the University of Sussex. So Jordan, I can't even thank you enough for being with us today, and I'm going to hand it off to you.
Thank you so much. I'm so excited and honored to have been invited. So thank you for the opportunity, and thank you, Bobby, for having me as well. I didn't know if I should put two beaches, Newport Beach and Laguna Beach. So I just put one beach, but I'm excited to be here talking to you again about, the kind of rear view mirror and then what we see kind of looking forward. It's a fun time to be talking about the economy, talking about the market, because we're now, what is today, the 25th. So we're on I guess it's the 10th full day of reopening now, so we can actually do stuff again, and not just because we're no longer prisoners in our own home, but also because when you look at the actual data that's been flowing in, it's been pretty encouraging, right? Both in terms of those broader kind of macroeconomic variables like jobs or unemployment insurance claims or consumer confidence, corporate profits, GDP, all of these kind of nerdy economic indicators that guys like me look at all the time have all been moving in the right direction. And then, for us in housing in particular, we've been on the leading edge of that recovery, right? We've been growing faster than the kind of broader economy at large, certainly a lot faster than what I would call the kind of Main Street, brick and mortar type of economy. And so things have been looking pretty good. And with the prospect that, the reopening is going to broaden out, we have more to look forward to, at least from a kind of macro standpoint. People should continue to get those jobs back. Income should continue to rise. And yet, even as we are optimistic about things continuing to get better from here on out, I do want to kind of take the opportunity to warn you off the temptation of just throwing your business in cruise control, because we're getting into a point in time where all of this good demand that we've enjoyed up to this point, the strength of growth and home sales, is starting to come at the cost of our available supply. There is some signs that buyer fatigue is starting to crop up, whether it's because they're, afraid of the $820,000 median prices, whether they're suffering from that brother-in-law effect that says the market's, gonna tank, or that, once these kind of eviction moratorium and REO moratoria expire, that we're going to have all these foreclosures, or just the fact that folks are getting outbid on houses, right? We do see that kind of psychological impact on the buy side. We do see some early signs that we're starting to put a little bit more product onto the MLS every day, but it's still very early days there. But that really is what's needed, and why we can't be, super over optimistic when it comes to our forecast for home sales. We think that, people are going to continue to want to buy. Rates might go up a bit, but they're still going to be fairly attractive from a long-term standpoint. We know that home ownership and having a home that actually meets your needs is more important now than ever before, with people telecommuting more and doing things like that. But there is a lot of uncertainty, and this lack of supply is starting to create more challenges in the market, not just in terms of creating buyer fatigue, but just to really pumping up home prices. And that kind of leads me to the next part of the presentation that I want to share with you about this idea of whether or not we're in a bubble, right? How much of the prices that we're seeing out there are because prices are overinflated, and how much of it can we just chalk up to being explained by the fundamentals. And so I'm going to show you some analysis that I've done trying to answer that question, both when I did it looking at prices at year end when we had about a $715,000 median price statewide, and then how that's evolved over the last 6 months when prices have actually accelerated since then. And I think the moral of the story there for me is that I don't think that we're on the precipice. I think that especially when you're talking about just looking at the end of last year, prices were largely explained by fundamentals. We have seen an increase in the amount of systemic risk as prices have started to go up by 30 and 40%. That is not sustainable long term, but it also doesn't mean that we're up against the precipice. Hopefully what happens and what our forecast expects to happen is that supply and demand starts to work again, right? That all these student loans that I've been paying for all this time, like the last 22 years now, haven't been for nothing, right? That when prices go up, when there's excess demand and not enough supply, what that's supposed to do is create attractive selling conditions for suppliers. And again, we're starting to see that, but we don't expect a big enough kind of rebound in supply to where we're going to hang on to that 510,000 unit pace. So we're kind of optimistic about double-digit growth for both sales and prices, but we're just not overconfident that you can just kind of phone in the rest of 2021, because we think it's the second half of the year will be characterized by more challenges than what we've seen over the last 6 months, especially at the end of 2020 there. So let's look at some of the economic data. And I should mention as well that I'll send these slides around so that you can use these for client conversations or just in case I was talking too fast or what have you. But, when you look at the rear view mirror data, things are looking pretty good, right? These COVID numbers are lower now than they were even before we kind of issued that very first shelter in place back in early March of 2020, both in terms of the raw numbers and the 7-day moving average. We've now had, about 40 million doses handed out, which equates to almost 50% of the 58% of the population base. So that's all moving in the right direction. You can see that we did have a big spike in November that stayed pretty high right up through the end of January, but has since been coming down pretty precipitously. And the reason why that matters is just because of how closely tied the kind of economy was to the public health side of this thing. This wasn't an economic shock that was because we had big fundamental imbalances in our economy. It was because we pressed pause on economic activity and sent everybody home for a few months. And you can see how closely correlated our labor market performance has been to those kind of COVID numbers that I just showed you. So this is non-farm jobs. This is our employment base here in California. And you can see that during that very tight initial clampdown, we lost about 2.7 million of our 17.7 million jobs that we had in the state as we went into a virtual shutdown, right? Between April and November, we were still locked down, but we kind of started to get our arms wrapped around this whole social distancing thing, et cetera, et cetera. And we were able to kind of gradually ease up on some of those restrictions. And in fact, between May and November, we very quickly went back to a job jobs growth mode. In fact, just during that 5-6 month period, we had already added back 1.1 million of those jobs that we lost during that initial shutdown. So started coming back online very quickly, right? But what happened in November? We just saw that huge spike. We were seeing 30, 40, 50,000 new cases coming down the pike per day, had to relock down the economy. And again, overnight, we started shedding jobs again. Almost 155,000 folks lost their jobs between the end of November and the end of January. So tough economic times for the holidays for sure. But as we kind of got a lid on the public health side of this thing, you can see how quickly we've gone back into a jobs growth mode. We just got the May number. And now, just again, since the end of January, we've added back almost 500,000 more jobs, right? So we still have about 1.3 million jobs to go of the 2.7 million that we lost. But this is why we can be optimistic, right? Because as we're able to go outside again, as people aren't getting sick all the time, we can open the bars and restaurants and hotels, and those are in fact the types of jobs that are very quick to come back online. When people start showing up to eat at my restaurant, I bring my wait staff back, I bring my hosts, and when people book hotel rooms, I bring the cleaners and the chefs back, right? And so we see all of this stuff starting to play out. That's why we can kind of be optimistic about the broader economic environment as we kind of move forward. In addition to that, we also just had this really what I would call a perfect storm for housing demand that kind of brought housing to the leading edge of that economic recovery. First and foremost is that those folks who lost those 2.7 million jobs weren't necessarily the folks that could have been into home ownership in California in the first place. They were largely jobs lost from our 4 lowest paying industries in California. And just given where affordability, housing supply, all of that stuff was even before the crisis, you really had to be one of our high income earners to be able to get into home ownership in the first place. And those were the exact types of folks that were relatively insulated from the nature of this shock, right? Spreadsheet nerds like me are able to, we have some of the most remotable jobs, right? As long as you have a laptop and internet access, you can remain employed. And that is where most of the high income jobs are kind of located. And indeed, less than 10% of the jobs that we lost came from our 4 highest paying industries in California. You put that all together with the fact that housing, again, is more important to us now than ever before. The nature of this shock actually favored housing from a kind of structural standpoint, right? Because it changed our own relationship with our homes. It's not just where you go home and grab some food and go to bed before you head out to work the next day. It's, where you live, where you work, where you play. It's your gym, it's your school, it's your bar, right? It's your arcade. It's all of that stuff. It's where you're held hostage for months on end. And in fact, we saw almost overnight the median square footage, the closed square footage in California by, I think, April 2020 had already jumped up by about 120 square feet, reflecting that need for additional space, the work from home, just kind of all around more need, the more demands that we were putting on our homes, which were more important to us than ever before. And you kind of throw that into the mix with the fact that we no longer have guns to our heads, forcing us into the office every day, even as the economy reopens. And we were kind of joking about this earlier this morning, right? Is that at least some of the work from home is going to be permanent. You might go back to the office, but you might work from home 1 day a week. You might work from home 1 week a month, right? You might remote work from somewhere and start vacation early, right? And be able to do stuff like that. And so it just opens up a lot more options in terms of where folks live. I think, Newport and Laguna are prime examples, right? You probably have more folks that are willing to make that trade-off now that they don't have to drive to Irvine or Anaheim every day for work and things like that. And let's not forget the critical value of rates that were at all-time low levels. In fact, I always joke that I'm the son of a guy who used to walk around bragging about his 12.5% mortgage interest rate back in the 80s in San Diego, and he would have killed for 2.6% mortgage rates, which we hit early this year. We're still below 3% according to the Freddie Mac number, although the daily numbers continue to go up. But still, even at 3.2%, right? That's still very low from a long-term standpoint. And indeed, that kind of perfect storm did materialize into a lot of buyer demand. A lot of folks last year took that plunge and finally got their foot on the property ladder. In fact, we had the biggest share of the market as first-time buyers that we've seen in a decade, right? Almost 40% of the 2020 housing market was first-time buyers, but they tended to be the relatively more affluent first-time buyers. Those long-term renters with high incomes, probably had the boomer parents with lots of home equity that, were able to work remotely, that did kind of now have that sense of urgency in terms of having more need for work from home space, and maybe their open plan condo with that, allowed them to walk to the office or whatever wasn't really fitting the bill when you have this kind of dueling Zoom meeting kind of vibe in your 800 square foot loft. And now all of a sudden single family seems to make sense. But again, these were, actually 33%, more than 33% of these first time buyers last year put down at least 20%, right? And so again, when you kind of put on that economic hat or look at these numbers through the economic lens, right, that we just talked about, where those high income earners, folks with stock portfolios, which also have come back much quicker than the Main Street economy, those folks with, parents with equity to dole out, who wanted to take advantage of the low rates, had the wherewithal income wise to do it. Again, finally had that kind of kick in the pants that they needed to finally make that plunge into home ownership. These weren't the kind of $60,000 a year middle class scrap your way into home ownership first time buyers, unfortunately, but we did see the needle move, at least in terms of getting some folks into home ownership. And I think a testament to just how the kind of ante has been upped from a long-term perspective on just the value of home ownership. And I think you see that reflected in these numbers here. You certainly see them reflected in the market data, right? We just put out our March statewide, or excuse me, our May statewide press release last week, and the housing market was up almost 90% on a year over year basis from where we were in May of 2020, right? Through the first 5 months of the year, we're up almost 35% in terms of closed transactions compared to where we were through the first 5 months of 2020. And that's happening even as prices are growing by almost 40% on a year-to-year basis to new all-time high levels, right? And so the market is, again, when you kind of think about it through that home ownership lens, through that kind of perfect storm lens, and through the economic lens, the kind of fact that folks are hungry for housing, it couldn't be more evident than, and you folks are the ones who are seeing that on the ground. What's really interesting is that where this demand is actually taking place, right? So yes, we did see an uptick in outmigration in 2020, but when you read about that in the paper, it seems like all bets are off, right? And California is pretty much a sinking ship, and they're either moving to the Central Valley or they're moving to Texas, and that's pretty much the only two options. But in fact, if you look at where the home sales are happening, well, first and foremost, if you look on the right-hand side, you can see the home sales are growing everywhere, right? There isn't a single region in California that has less than 44% increase in home sales last month. But what you can see is that where sales are the strongest is along the coast, right? The Bay Area, Southern California, and the Central Coast. And so as much as we read about California's mass exodus, and folks, did leave in increasing numbers, it was a drop in the bucket relative to overall housing demand. And folks are also simultaneously, while some folks are becoming discouraged with California, an even larger number of folks are putting down roots. And again, we know that a lot of these folks are first-time buyers, and they're doing it not in the most affordable parts. They're doing it in the desirable parts, right? And indeed, if you actually look at the index of home sales in California, so that we can, set March 2020, the pre-crisis number, as kind of 100, and then see what happened to home sales across all these regions on an apples to apples basis. Well, if you look at the far right-hand side of this chart, you can see a couple of things. First, you can see that every single region in California is above pre-crisis levels. We have more than clawed back all that lost ground, that we saw during March, April, May of 2020, and are at basically, cycle high levels of home sales. But again, which ones are the highest, right? The Bay Area, the Central Coast, and the far north and Southern California are both smack on top of each other, right? And so again, it's not all just happening in the Central Valley. Don't give up on the cities. I don't think that consumers have, right? Home buyers are buying in the city, especially now that we can go out to eat and do all that, cultural stuff that we've been so craving. I moved up to San Luis Obispo way before this crisis happened, and we moved to have more property and open space. It's a little bit more rural, but I can tell you, just in the first 10 days of the kind of reopening, we've already gone to every single restaurant in the entire region now, like twice, right? And so I think that the kind of cultural draw of cities, where people want to go to the beach, they want to go to ball games, they want to go eat at restaurants and go to concerts and do all of those things, again, I think can't be understated. And I think you're seeing that embodied in this kind of distribution of where the actual home sales are still happening here in California. You also see that, across price segments, every part of the state is growing, right? We're seeing, except for 0 to 300, which is basically a non-existent category. We want you to, try and record any sightings of $0 to $300,000 homes in the wild, and if you can, capture them so that we could take it back to C.A.R. and study them in the lab. But with the exception of that kind of increasingly rare, segment of the market, every part of the housing market is growing from 3 to 500 all the way on up. But the top end of the market is doing particularly well, and I think for the folks in this group, that should be a real sign of encouragement. Again, the high income earners continue to do better than everyone else. The stock market continues to come back much faster than the Main Street economy. You have a lot of folks from the Bay Area who are looking to relocate to Southern California now that they don't have to drive into the office all the time, or maybe never have to work there again. As unaffordable as people think Orange County and Newport Beach is, right? For folks who live in San Francisco, where you get a 800 square foot condo for 1.7 million, looking at what you can get for 3 million in Newport is still pretty attractive. And you see that playing itself out across these market segments, with 2 million and up having been up 300+% last month for the second month in a row, over 300. 1 to 2 million was up, again, 180 percentage points, where 750 to a million was up, I think, 130 percentage points. And so it's no surprise then that when, with the top end doing well, with those high income earners doing well, that, just Orange County as a whole is, doing better than the statewide average, right? We're more concentrated in those kind of high end units than other parts of the state. And so while California as a whole was up almost 90% in May, Orange County was up 130% in May. And again, even as prices rise by more than 30%. In fact, Orange County, I think it's been maybe 3, 4, might even be 6 months now that Orange County's been in the million and up club, right? $1 million median price. It's the first non-Bay Area market in California to get into the $1 million median price club. And so again, to be able to achieve 130% growth, even as prices are rising way faster than incomes, is pretty incredible. But you see that kind of same segment effect playing out across Orange County. And so I know, we'll get to you guys last, but if you kind of take a low price to high priced walk just across Orange County, you can see that same kind of phenomenon that we saw at the statewide level, right? Because if we go to, Huntington, the relatively affordable Huntington Beach market at just 1.1 million, you can see, that sales were up about 140% in May, which is still better than the statewide average, right? And again, price is rising at a pretty healthy pace. But as we start to move up the price spectrum, you see that the sales growth actually gets stronger and stronger for the most part, right? Laguna Niguel at about 1.3 million is up about 145% on a year-to-year basis, with a 5-day median time on market. Just absolutely incredible. Coto, right, at 1.6 million is up, again, almost 160%. So the higher we're going up the price spectrum, the kind of higher we're the stronger we're seeing the growth in the marketplace, which again, I think through that economic lens, and that's why I kind of belabored the nerdy econ stuff at the beginning, is because I think it all starts to make sense when you look at it through that lens of who's doing best at this point in time economically. San Juan Capistrano at a $1.8 million median price, give or take, again, also up 1.5 or 150%. But look what happens when we start to get into the really expensive markets. You make that jump into the 3 million range, right? You go from 120, 130, 140% growth to 250% growth in Laguna Beach, right? 11-day median time on markets, even with $3 million, give or take, median prices, and prices at the top end still rising by almost double digits, right? Which is just absolutely incredible, right? Median time on market of just 15 days with virtually no discounting to speak of, which is pretty rare at the top end of the market. If you know anybody that owns a home in Newport, you should be showing them this chart and showing them that they, will go pending in 2 weeks and not have to negotiate. I think that's the secret to success there, right? 185% growth at 3.13 million. So just a lot of these, it was really nice because you have this kind of hypothesis from looking at all the statewide data, and then you look at coastal Orange County, and everything kind of lines up with that broader economic story. And when you look at the actual kind of broader trend, what's interesting is that, for the state as a whole, we really embody that microcosm that you see happening in Orange County, because for the last 2 months, it's been the first time in history where we sold more homes that were $1 million or more than we sold homes that were $500,000 or less, which that used to be, all of California's housing market. And it's just a testament to, again, how strong that market is, that so many homes have just, now graduated into the plus, being more expensive than 500,000 just in terms of overall raw value. And so some of that is why we're seeing such robust growth in home prices, right? Part of it is because, Laguna's up 300% or whatever it was, and that Newport's up 160%, what have you. But, and I think 2 million and up in general is up 300%. So part of it is the mix of sales has changed, right? When you have a lot of transactions happening at the top end of the market because those high income earners are doing really well, that does tend to drag up the overall median price, which hit, again, an all-time high of almost 820,000 last month. But my friend Oscar crunched a bunch of numbers on this and stripped away that kind of shift towards the top end and just looked at a kind of constant mixed basis. And even if you take away, the increase in all the expensive homes, you still see that prices, values are growing in the high double digits, right? Like by 17, 18, 20% even. And that is backed up when you look at kind of growth in prices on a per square foot basis, even within, a given city. So you kind of strip away the fact that we sold all these big giant villas, you still see really strong double digit growth. And we kind of know that intuitively as realtors, right? Because we see that when something hits the market, it goes pending incredibly quickly. Statewide, we had a median time on market. That's the number of days it takes for hitting the MLS to going pending, was 7 days, an all-time low. And again, this is a median, right? So that means that 50% of what closed last month closed or went pending faster than 7 days, which is just, baffling. And I think explains some of that buyer fatigue, but also why we're seeing so much, or I guess so little discounting out there, so little negotiating. We had a median sales to list price that hit another all-time high of almost 104% last month. And that again means that 50% of everything that closed last month had at least a 3.8% premium over list. Or at least, whether you call it a premium or not, it was 3.8% over. I'm sure the people who paid that didn't think it was a premium. They were happy to get that home. But so the point being is that, not all of this growth in home prices is just because we're selling a bunch of $8 million properties. There's also signs of real, honest to goodness excess demand where we have so many buyers and not enough homes to put them in that it leads to this kind of commodification of the housing market where you see these kind of uber competitiveness stats like this, where 50% of the homes again are selling at least 4% above ask. If you kind of get rid of how far above ask and just say how many closed somewhere above asking price, it was 70% of what closed last month, right? So, which is just an all-time high, even in 2018, 2019, where the market was still pretty hot, right? We were still at like 2.5 or 3 months of supply. It wasn't all-time lows. It was at that time though. And even there, we were only seeing about 40% of the market close above ask. 7 out of 10 homes last month closed for more than what the seller was actually asking for, which kind of does create some of those red flags. We do a consumer survey because, you still get the Fannie Mae housing sentiment index, but that's like talking to people in Jacksonville, Florida, and Toledo, Ohio, and places where the median priced home is about $200,000. So we wanted to know what people in California felt like. So we started about 3.5 years ago talking to 1,000 California consumers, different California consumers every month, buyers, owners, renters, sellers, whatever, and just asking a battery of questions, 2 of which are, is it a good time to sell a home? And is it a good time to buy a home? And what we saw was that the people who said, yeah, it's a good time to buy a home, fell to an all-time low last month of just 19% of the respondents. 4 out of 5 people we talked to in May said, no, it's not a good time to buy a home. At the same time, the folks responding that it was a good time to sell a home soared to an all-time high. And so when you actually look at that gap between seller optimism and buyer optimism, that seller side advantage is the highest we've ever recorded, right? And so this is leading to that kind of buyer fatigue, whether folks are getting outbid, suffering from that brother-in-law effect or what have you that tells them the market's about to tank. We do see this starting to impact folks' psychology out there, but it's actually starting to have more material impacts to the market beyond just kind of the stories that you're hearing at these barbecues that we're now finally allowed to go to. Because if you look at the pace of growth in mortgage applications, which tends to lead closed sales by about 45, 60, maybe even 75 days, what you can see is that since about mid-April, those mortgage applications have been decelerating, and they were falling from that kind of 60% growth level that we were at back in April. And they were falling or decelerating pretty consistently to the point where the last 4 or 5 weeks, we've actually seen the number of mortgage applications finally fall for the first time in more than a year. And part of that you need to keep in mind is that we in some ways saw this coming, right? Because the growth we were seeing in April, when it was growing by 50 and 60%, wasn't necessarily that the demand was so head and shoulders above where it was at Christmas time, but rather that we were comparing it to the part of the year in 2020 when the market was falling off a cliff. And so even as we're optimistic, and you can see there's nothing to really panic about, the level of mortgage applications here, and these are just purchase applications, they're still fairly robust. They're pretty decent, right? But they're not head and shoulders above 2020 and 2019 the way that they were at the end of last year, right? And so again, we still see a lot of buyer demand out there, but it's not the kind of level of buyer demand that suggests you can kind of phone in the rest of the year from Hawaii and just throw your business in cruise control and kind of ride this wave that's been building up over the last 6 months. You're going to have to convince folks that it's still a good time to take advantage of low rates, of that long-term value of home ownership, of just, what $3.3 million home prices look like at 4% interest. God forbid we ever get up to that level, right? But I think that there is going to be a little bit more convincing that we're going to have to do on the buy side, as folks, maybe are suffering from that buyer fatigue. And indeed, if you look at the number of closed sales, even as we grew by almost 90% on a year-to-year basis, right, in May, and we're likely to see that number even go up for June, right? It's also true that we were falling from that 510,000 unit pace that we were at in December. So part of the 90% growth that you're seeing is because of that kind of exaggerated effect that we saw 2 months ago in mortgage applications, where it's not necessarily that sales are so high. They're still near 450,000 units, which is better than we've seen, anytime in the last decade outside of the prior 6 months. But it's also true that they have been struggling to maintain that momentum. And so we still think things are going to continue to get better, but I want to make sure that when you kind of download my weekly market update, which hopefully everybody's downloading, and gives a roundup of all of our weekly MLS data and also any other cool nerdy econ data that comes out, those numbers are probably going to continue to show really strong growth. These are our weekly growth rates running right up through 2 weeks ago. And you can see still 80, 90% growth. We might even get to 100% growth. But I want you to interpret those numbers at least with some caution, not because we don't think things are going to get better, but because I want you to approach your business with a kind of nose to the grindstone, foot on the accelerator, kind of beating the bushes type of mentality, because the numbers aren't quite as good as what the headlines would have you believe, right? And so I just want to make sure that you're still kind of keeping the pedal to the metal, as it were, when it comes to your business. The good news is that we're starting to see some very early signs of light at the end of the tunnel, or we don't know if it's real light or just that we're hallucinating because we've been in the tunnel for so long. But if you look at the number of new listings, right, that's how much we're actually putting onto the MLS every day. Those numbers have started to rise. And actually, if you squint at this chart on the very right-hand side, you can see that actually total active, that's just a snapshot of how many listings were active on the MLS every single day. Those numbers have started to rise very, very, gradually, shall we say. The number of stock that we're putting onto the MLS has finally started to outweigh the number of homes that are closing off the MLS every day. So active listings have started to go up. We still have a long way to go there. In fact, if you look at new listings, we put 23,000 or so homes onto the MLS last month, which is, a good number. But this time in 2019, we were putting almost 30,000, 35,000 or so homes onto the market every single month. So yes, things are moving in the right direction. We have some reasons to be hopeful that, now that folks don't have to, or that we can have open houses, right? That we don't have to have all these crazy forms for people to walk in and out of our homes, that some of that pent up supply will come online, that, supply and demand does work, that you look at your neighbor's house and go, man, they sold that for 3.5 million and went pending in 8 days. Maybe we should sell our home, right? That mechanism should start to kick in, but we still have a long way to go. We're starting to see it. We don't want to get too carried away, patting ourselves on the back, because inventory is still very tight. The market is still very competitive, and that is pushing prices up at a pretty significant clip, which kind of brings us to this question of whether prices were overheated. And so I'm going to share with you first an analysis that I did looking at the end of 2020 to kind of give us a framework to understand, and then we'll kind of fold in what we've seen happen over the course of the last 6 months or so. The kind of moral of the story, though, is that if you look at prices at the end of last year, even at a median price statewide of about $715,000, that number was largely explained by fundamentals. I joked how my dad was, a guy who always bragged about his 12.5% mortgage rate when rates were at 15, 18%. The reason why rates were that high back in the early 80s was because we had so much breakaway inflation. Nowadays, inflation isn't even a consideration. Non-econ nerds don't even think about inflation in terms of how it affects their daily life. And yet, even though we don't have that breakaway inflation that my dad used to have back in the late 70s, right, that gave him those high rates, the cost of goods and services in California has still gone up, right? It's been much lower and much more steady, but things, just things, right? Stuff, haircuts, gas, groceries, what have you, has gone up in California by about 2.5 times from where it was at the end of the 1980s. And so we should expect at least a 2.5 times increase in home prices over that time, just because the cost of everything has gone up in California, right? Well, here's the rub. 1980s, right? End of the 80s, we had about $150,000 median price, but by the end of 2020, we had a $715,000 median price. That's a lot more than 2.5 times growth, right? And so what has folks worried. But what you have to keep in mind is that 30-40 year period was also one punctuated by incredible decline in mortgage interest rates. And if you think about what that means, in a market like California that's so inventory constrained as we have been basically since the 1990s. We've really been underbuilding for the last 30, 40 years, is that these reductions in rates, which, usually in a kind of normal market clearing environment would have represented savings for consumers, right? Now I can get the same priced home. It doesn't cost me as much in my monthly payment. But that ended up getting passed on to home sellers because the market was so competitive. Buyers needed whatever advantage they could get. And so when they got a windfall savings on interest rates, they didn't just pocket that savings. They went out and borrowed more money, which they were able to now do without screwing up all those debt to income ratios and things that the mortgage bankers care about. And so again, this, what would have otherwise been a windfall got passed on to sellers in terms of higher home prices. And so that really kind of compounded the increase that you would have got just from the fact that everything was getting more expensive in general, right? That was kind of the double whammy that really compounded just what we saw on the overall inflation side. And so when you kind of fold those two factors in and look not at the price of the home, but the payment on that median priced home, which does account for low rates, right? Because that home cost me less at 3% than it does at 6%. And you put it in real terms, right? You strip out all of that inflation, you put it in apples to apples so that we can compare 1988 the way that it was, in 2020, as if it was in 2020 dollars. And what you can see is that if you strip away that inflation and look at this in terms of a mortgage payment instead of an overall price, prices at the end of last year weren't particularly inflated. Yeah, that median priced home of $717,000 or so cost you about $3,200 a month. That was slightly higher than this historical average of about $2,700 a month, but it was lower even than it was at the end of the 1980s and a lot lower than what it was in 2007-8, right? And so what's interesting is that the composition of this payment is different, right? It's $3,200 a month now because we have really high prices and low rates compared to, at the end of in 1988, it was $3,200 a month because we had really low prices and really high rates. But that doesn't mean that the level of that payment is particularly inflated. And once you bake in incomes, right, which is the other side of this, and say, what does that $3,200 a month look like as a fraction of what the median family in California actually earns? Again, the price then doesn't look particularly inflated. In fact, we are almost bang on historic levels of where California is. It certainly wasn't consuming 8 out of every $10 that of pre-tax income that it was back in 2006, 7, and 8, right? We can also look at this in reverse and ask, we know where incomes are, we know where rates are. What should prices look like, just given that we know how much money people make? If we were in a perfect world where that median household was getting the median priced home and we had a kind of no inventory constraint and a perfect market clearing type of environment, you can do that calculation and kind of reverse engineer what home price you would expect to see in an environment like that. And so if you just take incomes and interest rates as a given and assume that people are spending the right amount of their money on housing, like 30 or so percent, 30, 35%, you can actually do that calculation and see what the hypothetical price should have been, right? And there we've done that calculation. And just based on the fundamentals of where rates and incomes actually are, you should automatically expect home prices in California at the end of last year that were between $515,000 and $600,000. So they were a little bit higher at about $715,000, $720,000, but we can actually do that comparison and see how much higher and how does that compare to where we have been historically, right? And you can see again, we're about 20% above that hypothetical market clearing price. Guess what? That's where California always is. A 35, 40-year average of that calculation shows a 20% price premium, right? By the way, that's kind of how I would go about quantifying the it's a nice place to live effect, which we always hear like, yeah, California is always going to be more expensive because it's so nice here. And I think that's true. I think that's what you're seeing in this chart, right? California is always about 20% more expensive than you would expect to see just based on looking at incomes and interest rates in a bubble. And I think that is because it's so desirable. But what do we not see, right? We don't see actual prices that are 115% higher than what you would have expected to see based on how much people earn the way that it was back in 2006, right? So again, were less affordable than you would see in a place like Texas, Nevada, Arizona, but that doesn't mean the same thing that home prices are overly inflated by historical California standards. In fact, these, are largely explained by interest rates having come down so much, the cost of everything having increased, and the fact that people make more money now in California, right? So that was the end of 2020. I wasn't that scared. I thought that, prices looked about where you would expect them to be, and looked fairly sustainable. The rub is that they've now gone up another 35% or so since then, and again, I can assure you as a wage and salaried worker that incomes aren't growing by 40% on a year-to-year basis. And so that does, increase the amount of systemic risk. Rates have helped to offset that some. So if you look on the right-hand side, the mortgage payments only up by about 35%, even though the prices were up 40%, right? But guess what? Incomes didn't rise even by 35%. So again, we're still behind the 8 ball. We don't know what incomes are going to do, right? We don't get income data except for on a very lagged basis. So I won't be able to update those calculations for a while, probably not till the end of this year, early next year, but we can bake in some assumptions about what we think is happening with incomes. And even if I'm generous and say incomes are up 10% over the last year, you can see that will have upped the systemic risk in California. We're now, about twice as high above that market clearing price as we were at the end of last year. The good news is we're nowhere near the levels that we were back in 2006. So I think, the brother-in-law effect is still totally misplaced. I think even in a worst case scenario, all bets are off kind of economy, which is not our forecast. We're still forecasting double-digit growth. But even if we're completely wrong, this kind of limits the extent of the kind of worst case scenario, right? Because once prices fall below this market clearing level, then you start to see what happened in 2012 and 13, right? Prices fall below some kind of fundamental dictated number, and people perceive that as bargains. They get in and drive up demand, which pushes up home prices, and you kind of settle at where that kind of fundamental level should be. The good news is this kind of also justifies my student loans because it suggests that economics still works. So there is more systemic risk. We have less potential for snowballing, even as the amount of systemic risk is also nowhere near the levels that we saw back in 2008. I'm not going to belabor these because I know I'm already probably over time, but we don't have the same kind of mortgage market. I think shenanigans is the technical term, where we had half of all the mortgages we were originating were these kind of 5-1 option arm ticking time bomb mortgages, right? That was less than 20% of the market and has been for the better part of the last decade. So again, we don't have all these kind of ticking time bombs just waiting for a Bear Stearns, Lehman Brothers to crash and really get the snowball rolling on much deeper fundamental imbalances. We didn't really use our homes as bank accounts this time around the way that we did last time when we were buying motorhomes and boats and taking everybody to Europe because our homes had appreciated so much and we were rich, right? That is a positive. We still have skin in the game. You don't throw the keys back to a bank on a home that you have equity in just because you lose your job, right? If you have equity and you got a lot of buyers lined up around the block, you sell that home. And of course, that is something that also is a feather in the cap. It doesn't insulate us from the effects of the crisis. If you lose your job, you might not be able to hang on to that home, but you don't have that extra strategic kind of incentive to just walk away and don't look back. And that's why you see that both, the forbearance numbers peaked at just a little over 8% compared to more than double digits last time, but also why they've now fallen and been more than cut in half. So the amount of folks who are struggling on their mortgage has already come down. If you look at the folks who've gotten out of forbearance, it really provides a lot of optimism that we're not on the brink of a foreclosure crisis. If you start at the bottom of this chart and we work our way around kind of clockwise from about 4 or 5 o'clock, you can see that 8% of folks in forbearance actually paid off their loans in full. And again, that is a symptom of folks who maybe did fall on hard economic times. But again, when you have home equity, you can actually sell that home and might even be able to pocket some money to help bridge you through to better economic times. But if you work around after that, 2/3 of the folks who have gotten into and subsequently out of forbearance, which is more than half of the folks at this point, either, 1 out of 4 never even missed any payments whatsoever. They took out forbearance as an insurance policy and didn't ever invoke it. 14% went into forbearance, paid the money back already in a lump sum. So, no foreclosure risk if you're already caught up on your mortgage payments. Another 27% just took all the missed payments, added them on to the end of the loan. So there's no big balloon payment. There's no coming up with, thousands and thousands of dollars to get back on track. That represents very minimal systemic risk to, additional foreclosures. Even the next chunk of 11%, right, got a loan modification. So they brought down their rate. They stretched out the mortgage another 30 years. Again, assuming that you get your job back, you can hang on to that home under those conditions. It's only about 15% of folks who've gotten into trouble this far that have absolutely no plan on how to deal with it. And so, to me, that makes me optimistic. Not that we're going to see zero foreclosures, right? Some of those folks aren't going to have a plan. Some folks did cash out on home equity, and they have that home equity sitting in their driveway in the form of that, fancy new boat. So we will see some foreclosures, but it's not going to be 60% of the market the way that it was last time. In fact, our kind of baseline is starting to look more like our best case scenario. We're expecting REOs to happen, but they're going to be in the low single digits when you look at it as a percentage of the market, not, 3 out of every 5 homes on the MLS, right? So that being said, we have upped the systemic risk. So we want to keep an eye on this bad behavior, right? Because prices are outstripping incomes. And, I showed you the cashing out refis up to the first quarter of 2020, which weren't that big of a problem, but look at what's happened over the last 4 quarters since prices have started to rise by 30 and 40%. We're still nowhere near the kind of 2006 crisis levels, but we have really started to feel rich again, and we can't have 40% growth in home prices and people liquidating all that home equity and not be scared about the fact that we're increasing the amount of systemic risk. To me, the bigger issue is that we got to get busy on supply, right? Because even at 2.6% rates, affordability was already falling, and we expect rates to go up. This is a really technical, terrible econ nerds chart probably, but the moral of the story is we expect rates to continue to go up probably by about 30 or 40 basis points by the end of the year, ending somewhere in the kind of 3.5% range. And that's, why we need to get busy building. We never build enough in California. We are building less now than we were a few years ago, even as the economy is coming roaring back. And that's why, we have all these kind of really gruesome and scary records when it comes to housing. Second worst for rent burdened, second worst state for overcrowding, number 1 poorest state in the nation when you look at the poverty estimates that actually account for housing costs. And so that is why, you hear that big giant sucking sound. Part of it's California's business unfriendliness, but actually I would argue the vast majority of it is California's housing affordability crisis. The vast majority of this 261,000 people that left last year, which is the biggest number we've seen in a decade, were folks that make under $100,000 a year for their whole entire household. So, those are the ones that tend to benefit from California's crazy progressive tax scheme. And yet, even though we kind of have those folks, leaving in bigger numbers, we actually had the first time ever California's population actually shrank. And that's going to be a problem for us in real estate, but it's also going to be a big problem for our economy, right? Because, places like Japan, which have hugely productive workforces, still can barely, offset the negative consequences of a shrinking population base. And I think that if we're not careful, that's where we're headed. So the moral of the story for me is to, yes, you can be optimistic about the rest of the year, but no, you don't want to be overconfident. We're forecasting double-digit growth in home sales. And actually, I'll probably revise my price forecast to be up by double digits as well. But if you look at the level of home sales, we're not going to stick at that 510,000 unit pace that we were enjoying at the end of 2020. Mostly because we don't have enough inventory, and that continues to pump up prices and reduce housing affordability, in addition to just, making a lot of potential would-be home buyers pretty sad. So yes, the housing market's doing well. No, we can't just kind of shrug off the fact that 40% growth in home prices isn't sustainable. It's not explained just by the fact that rates are low and inflation has happened, right? There is going to be a limit to how long you can have 40% home price growth. And so we can either do it the easy way, right, by getting more supply on the market and cooling things off and getting prices that are still growing but just growing more like what we see happening on incomes, and therefore, kind of cooling off without creating all these major problems. Or we can have a bubble and subsequent collapse. And so I think the key is to work those connections that you have, get more homes onto the MLS, and start considering becoming a housing advocate. We need to build more housing, and that's how we're going to offer the opportunity for people to buy and own their own homes and really ultimately save California's economy. So I know I probably went too long, but I will end by saying thank you. And if you still have questions, I have some time if you want me to entertain those too.
There is a question in the Q&A field.
Awesome.
So back to when you were showing the Orange County, Newport Beach, Laguna Beach, the statistics. That's when this came in. It says the sales increases are pretty spectacular, but aren't they being compared to 2020 when people were hunkered down?
Yes. Yeah. So you're seeing that same exaggerated growth rate that we saw in that statewide trend line chart. But you're seeing the same thing, right? It's both. It's a mix of both. The level is high, but it's just not as high as the 185 Newport Beach % growth would suggest, right? In the same way that kind of, yes, the state was up by almost 90%, but it was actually at 450,000 units instead of 510. You see that same thing playing out in those local numbers, that, the level is still high. I think like doing 40, or I forget the exact number of sales that it was in Newport, but that was still a large number of sales for a particular month. But that 200% was exaggerated because the last May's number was depressed. Absolutely true.
We have another in the Q&A field. Excellent presentation.
Yeah.
Do you have any similar data on rentals, both the rent as well as the value of income properties, i.e. versus residential properties?
That's a great question. I've thought about making a new product similar to that was kind of an investor guide. So we have on our website those actually, that's our market overview report, which you can go download the Newport and Laguna report every month. We refresh that every time we put out a new press release. Those numbers get updated, and we actually have every city, or like I think there's like 450 cities that we're covering in that, a lot of them in Orange County. But we also have a buyer's guide, which shows you how much inventory and units are out there across all these, like 1 bedroom, 2 bedroom, 3 bedroom by city. And then we show, what's a 20% down payment on that home. What is what's the payment on it if you put 5 or 10% down, that kind of a thing, to give buyers a sense that it's not as far out of reach. That's the kind of long way of getting to your question, which is that I've been considering adding an investor guide too, so that we have a market overview, a buyer's guide, and then an investor guide that talks about ROI and says, here's what the cost of that home is. Here's what you can turn around and expect to rent it out for. Here's what like a cap rate might look like, or here's what a, time to get the numbers back would be. I just haven't prioritized that one as much because, the kind of investor side of the membership is smaller, but it is a critical kind of aspect where realtors are looked to as a source of expertise for that clientele. So even though it's a smaller share of the overall mix of the business, I think it's an important segment. So I don't have that right now, but I appreciate that comment because it kind of motivates me to maybe take that to prime time a little bit sooner.
Great. And then Jordan, will you by chance be able to send your slides to us for us to share with the members?
Yep. As soon as I get off this call, I'll email them to you, and then I'll also put them on the C.A.R.org website that you can get it at any time. Yeah.
Wonderful. Thank you. And Bobby put a comment in the chat that her members are going to be able to access the recording on their website under the education tab. And we'll also be emailing it to everyone who's registered and make sure it's uploaded as well, because the information you gave today is extremely valuable and we really, really appreciate your time.
Oh, good. Yeah, I'm glad. This is a fun area to talk about. It's fun to talk about sales going up 100%, but to go to an area where they're up 200% and 300% is even better. So I appreciate the invite, and I look forward to the next one.
Great. Thank you so much. Everyone have a great day.
See you.
Bye.
Thank you. Bye-bye.